Thanks for joining us once again. I decided to do a follow-up show to our Tesla earnings show, and I call it the Tesla Trading Show. So about 90% of the viewers that I've dialogued with are really focused on medium to long-term investing and trading relative to Tesla, its earnings and stock, etc. I know there's a segment of you that switch into a little bit of day trading or a few days trading as we head into the earnings period. And I therefore wanted to kind of make a show in this space and throw out some of my ideas on what I see going on that might assist you in your process as we go into the trading zone of the arrival of earnings by Tesla. This is Greg for Teslafaninsight. Thanks once again for joining us. If this is your first time, welcome. If you're a repeat visitor, welcome back. We also want to thank our Patreon supporters. If you enjoy the show, would like better ideas on investing and trading, please join us on Patreon as well. Your like and comments are greatly appreciated. So what I'm fascinated by is that if you look at the arc of our show over time, there was a period when there was a lot of delta or dramatic stock price movements surrounding Tesla's earnings that allowed the folks who were on the right side to make a great deal of money. And I'd have to say it's not bad to make money. It's good to sort of understand the environment you're in. So what I'm going to do today is sort of generally review what's been going on in the trading space and with Tesla, and then make a couple of suggestions that I think are worthwhile experiments for you to consider doing as we enter this sort of trading zone driven by the high volatility surrounding the arrival of Tesla's earnings. So the number one thing, frankly, is that we've actually stopped even messing with the trading stuff. And the reason is that, as you know, Tesla is the number one option traded stock on any exchange. So there are a lot of people that know about the volatility of Tesla's earnings arrival, trade it, and use a lot of powerful techniques to manage that trading. So I got this idea for this show because actually one of my YouTube feed items that came up was they kind of followed the trail of a gentleman who learned how to trade and then became a fairly successful trader and then was arrested and put in jail for the techniques he was using on the trading. So the arc of time that they looked at is probably over the last 5 to 7 years. And I have, the first thing about trading that I think is interesting is that I have a viewer who used to send me almost weekly or almost daily notices relative to the charts that were available and his analysis of what was going on. And so probably 8 months ago, he stopped doing it completely. And the question is, why is that? And I think the answer I know. So as you may recall, the first thing to note about this is that for people who are doing very tight trading within a few hours, a few minutes, et cetera, there's huge amounts of computer systems that are really expensive that are pushing data to establish control of how to make money in the short term. So there are people that are in it for seconds, milliseconds, etc. In that realm, I keep thinking of the term, the forest from the trees. So you can look at a situation and say, hey, there's a bunch of trees in there, and I'm going to figure out which tree, to tap or whatever you're going to do with it. But then if you step back, you're going to notice that there's a forest, and then there's multiple forests, etc. The challenge that's arrived, which has blown up day trading, is that in some cases, or in like 90% or some high number, we've stopped the process of actual individuals trying to trade against each other, etc. And we've entered the realm where bots control that trading space. So as a result, you can see things that happen in very short periods of time where they're doing a technique called scalping. So all you're trying to do is get into a stock, um, make, 5 cents per share, multiply that by 100,000 shares, and get out. And now you have a profit driven by you're just scalping a few cents on that stock. And so human beings definitely can do this and have done it in the past. But the challenge is when you battle the scalpers, you're screwed because if it's a trading environment that has very short-term yields for results, as I just described, that's almost impossible for a human being to do because you can actually have that computer in and out of that trade in multiple trips in in milliseconds, and the parameters that they've set up for that trading, um, you know, is benefited by their speed capabilities and the CPU capabilities they have, plus their access to preferential treatment by the institutions that are trading for them. So I just think that there's money to be made there, but I just feel like it's very difficult if you don't have the resources, i.e. money, computing power, experience, to blend into this whole party. And forget about even things like, well, what about the dark pools and how um, they assist in the process of large institutions having a trader advantage over normal people. So all that said, there's one last thing, and it's sort of lurking among what I just said, and I call it sniffing. So the reason why the whole trading boom that we knew about, about 5 years ago and then beyond, disappeared was as we swung to computers doing the trading on an automated basis, you all of a sudden ended up with individuals getting wiped out. So, for example, if you're with a trading outfit that has a certain trading technique, the AI systems at the top end right now will identify who's making money, how are they making that money, and we want to institute a process for how we're going to blow those people out of the water that are making money and make money in the process of doing so. So hence, I've talked about this before, where the day trading folks just got crushed because the major houses and individuals have too much computing power to sniff out how they're making money and either join them in the making process or jump the other side of it and rig the market to bludgeon them. So the gentleman that I just mentioned to you that I saw a trading piece on, he actually got arrested, and the reason is that he had control. He was trading as much as $100 million worth of instruments, in this case stock. And the primary problem that he ran into was a technique that's been described as sort of, I want to call it reverse scalping. So what you do is you go in, put several orders in, either buy or sell. Then what you do is you watch how the market reacts to your buy or sell, and you simply cancel the orders, and you watch how the algorithms respond to that, and you take advantage of sort of creating a trading space based on your agreeing to buy or agreeing to sell, and then quickly sort of jumping the other side of the trade to make it a profitable situation for you. But the cancellation of those orders process is actually illegal based on the SEC. But for the smaller entities, they can actually get away with it, where large institutions might not be able to, because their trading records are being audited, and then they actually go to jail for that back and forth. So the preview basically that I just went through really emphasizes the fact that we've kind of moved into a new realm of computer-dominated trading, making it very difficult for individuals to stay in and make money in the short term. So I tend to focus all of my dialogue on what is going to happen and what you should consider on at least a 1, 2, 3 month time frame, and maybe, longer. So I wanted to sort of run this by, and based on everything that's been going on, what I really think is interesting as a trading technique is different types of straddles. So what's in a straddle? So Tesla's at about $260 a share right now, right? What a straddler would be is you literally buy a call and a put at the same strike point. That would be like a straight no-brainer straddle. Now, there's a gazillion variations on this. For example, you could say stock's at 260, I'm going to buy a 255 put, and I'm going to buy a 265 call. Or have your call puts oriented towards the direction you think that the stock may be going in. So for those of you with computer capabilities, what I really think is interesting to consider looking at, and you may want to try it out, in reality with just one share on either end of this or one option on either end of this, is a straight straddle right at 260. So what does that look like? Well, that means that you buy a call and you buy a put at the same strike price, and you give yourself time, 1 week, 2 weeks, 3 weeks, and see what happens to it. Because what trading is all about is taking advantage of volatility, and there's volatility created every time a big company gets into an earnings period, and then the byproduct of the readjustment of the market from those earnings gives you volatility from which you can make money. And we know that Tesla tends to move around pretty dramatically, and so the question mark is, how many points do you need for it to really flesh out? I'd have to say that I really think that one of the worst times to do this is right at the day of earnings, because implied volatility destroys value like crazy, meaning that you could have a great straddle, but the volatility portion of the pricing of that option will just crush you. So it's far better to wait until after the earnings. Now you can put the straddle in and get an opportunity to see how it works. Now, I'm empirically I'm mentioning this because of watching Tesla stock for a long time, watching it around earnings, watching its movement. I really think it's worthwhile to do an experimental portfolio of, I just suggested this, why not do an experimental portfolio of $10,000 on either side, and then watch what happens. Not the day of earnings, one day afterwards, because then you don't have crushing from implied volatility, and you get a chance to see what happens if you let the stock run on either side. So is this a strategy that a lot of people are doing? Absolutely. If you look there, you'll see puts and calls and all kinds of volume of activity that's going on. But I really think that if you dig through the numbers, you end up with a fairly consistent 10 to 20% profit in a 24-hour to 48-hour period with this strategy. And what I also like about it is that when you're on both sides, you're not trying to force the market one way or the other or take a wild guess. You're literally straddling the fence and allowing one side of the fence to win or lose, and not trying to push, if you will, the market around, because those are the people that tend to get killed most easily. So I really look forward to your comments on this. I think it's a great experiment to sort of back test what data you may have, as well as take a look at how this plays out. Again, the strike price is 260 in my mind. The time to do the trade is the day after we have the earnings and then the market's reaction right away, and then let that run out for a few days and see how it goes. I will update you on what we find and look forward to your comments on sort of this process. At any rate, this is Greg for Teslafaninsight. Thanks once again for joining us. Please remember to like and subscribe. Our health tip today is a reminder, don't forget your 25 leg lifts today and 20-minute walk for health effects in both cases. any rate, we really look forward to what your response is to this. Have a great day, and bye for now.